Welcome to Shooting It Straight with Stan. I'm your host, Stan the Annuity Man, America's annuity agent, licensed in all 50 states, glass half full, doggone it. Today's topic is annuities can have flexible income start dates. Annuities can have flexible income start dates. A lot of people out there, when they talk about annuities, they think there's only one. I want to buy an annuity because annuity company keeps the money when I die. That's one of 40 ways to structure it, Chester, okay, or Chesterette out there. These are customizable commodity products, and we represent all carriers at the Annuity Man, pretty much all carriers, the ones that we want, which is a lot of them. And you can run quotes 24/7, 365 at theannuityman.com using our proprietary calculators that moi, that's French for me, spent a ton of money developing and paying for and continue to pay for, because I want you to be able to run quotes and see the numbers on your terms and your time frame. Now, when it comes to lifetime income, there's primarily four products for lifetime incomes: single premium immediate annuity SPIAs, deferred income annuities DIAs, qualified longevity annuity contracts QLACs, and income riders that can be attached to variable annuities and index annuities. We don't sell variable annuities because we don't sell anything that has the potential to go down in value. And more importantly, the income riders that are attached to variable annuities are typically and historically not competitive to the ones that are attached to index annuities. We're not a big fan of the index annuity upside bonus, upfront bonus, upside with no downside, all that nonsense. We use index annuities as a efficient delivery system for that income rider contractual guarantees, because our saying is you own an annuity for what it will do, not what it might do. We never sell the might do. It's always the will do, the contractual guarantees of the policy. Those are the primary four types to do lifetime income. Now, there's a fifth, multi-year guarantee annuities, which is the annuity industry version of a CD, but that's not lifetime income. You can just peel off the interest like you would a CD or a bond coupon. So that's MIGAs, but I don't put that in the lifetime income category. Lifetime income are SPIAs, DIAs, QLACs, and income riders, because you're transferring the risk to the life insurance company that's issuing the annuity to pay for you as long as you are breathing, as long as you're on a ventilator. As long as you're breathing and breathing in oxygen, it's going to pay. So there's no way to calculate the return on investment until you die, period. There's no ROI until you die. But with a lot of you out there, when we ask the two questions, and these are the two questions we ask everybody, and when I say we, I mean the Annuity Man team. If you go to theannuityman.com, I have a team of really, really smart people, smarter than me. You might get me on the phone, you might not get me on the phone, but if you don't, they're going to ask you two questions. What do you want the money to contractually do? And when do you want those contractual guarantees to start? Now, the soonest that you can have income start with is typically an immediate annuity, 30 days from the policy issue date. But you can defer out as far as 10, 15, 20 years if you want to. All right. So let's kind of break all of these down. With the immediate annuities, SPIAs, deferred income annuities, DIAs, and qualified longevity annuity contracts, QLACs, those are what I call annuitized products. All lifetime income is a combination of return of principal plus interest. But these are kind of rip the knob off the water faucet. Once you start the income, it's coming, baby. It's going to hit your bank account as long as you're breathing. Now, you can say, but wait a minute, Stan, I answered the two questions. What do you want the money to contractually do? I want lifetime income for me and the spouse, or joint life, and I want it to start 5 years from now. That's what my projections and spreadsheets and check boxes say. But it might be 6 years, or it might be 4 years, or it might be 7 years. Then we're going to structure things contractually or point you to a product type that allows you to change the income start date. So you're not fully locked in. If you tell us that you might need to you might want the possibility and the potential to change that start date. Now, let's just look at that comment for what it is. Lifetime income is primarily based on life expectancy, your life expectancy, or if it's joint, life expectancies, plural, at the time you start the payment. Interest rates play a secondary role. Interest rates play a secondary role on the pricing. Just need you to know that. So if you decide, we go into the contract, you decide to use the Annuity Man, we shopped all carriers, we find the highest contractual guarantee, and the plan from the start, because we have to have a plan in place, is you're going to turn on income in 5 years. Okay. Now, if you get to year 4, and we're going to be in contact with you, not bugging you, but just saying, hey, how you doing? Anything changed, etc., on the yearly type call email. And you can always call us. I mean, we're always available. You can always book a call. You might say, you know what, we need to start it sooner. If you start it sooner, the payments will be lower because you are younger, which means there's more projected payments because your life expectancy is longer, which means those payments will be lower. The reverse is true. Let's just say you get to year 5 and we say, okay, you ready to turn the income stream on? You say, no, let's defer it for another year or 2. Okay, you say, no, let's turn on at year 7. That means the payments will be higher. Why? Because there's less projected payments because there's less life expectancy, which means the payments will be higher. It's really that simple. Okay. Now, with the vast majority of what's called income riders, again, those are attached to either variable annuities or indexed annuities. Vast majority, I can't say all because the annuity industry is not that uniform, but the vast majority, you can change the start date of that income rider. And in the annuity company, think about the life insurance company that's issuing the annuity. They don't care. Okay, we'll hold on to the money longer, or we'll turn on the income sooner, and they're going to give you your money back with interest as long as you are breathing, joint life, as long as one of you is breathing. And even if the account goes to 0, they're on the hook to pay, which is the value proposition. So it's no skin off their back. You just have to use us and my team as your administrative arm to do exactly what you want, whether it's to start the income sooner, start the income later, or start the income right on the dot from when you first scheduled that or attached that income rider to the policy. So income riders allow you to change the start date. Now, when we talk about single premium immediate annuities, deferred income annuities, and qualified longevity annuity contracts, let me give you the genealogy of those products. It all starts with single premium immediate annuities that were developed in the Roman times for the dutiful Roman soldiers and their families who were laying it on the line for the empire. And the empire said, you know what? Let's give them a pension, an annua, which means payment. Annua, annuity, see the correlation? And it's a lifetime income stream as long as somebody in the family was breathing. That's the genesis. That's where it all started, with single premium immediate annuities. Okay. Deferred income annuities are, in essence, single premium immediate annuities that defer past a year. I mean, it magically turns into that. I mean, really the same thing. No moving parts, no annual fees, no market attachments, a straight transfer of risk pension that you can customize the structure of. And then qualified longevity annuity contracts are DIAs, deferred income annuities, that can be used in qualified accounts, i.e. qualified longevity annuity contracts. So that all the people that are never bought an annuity inside of an IRA, you think? Not. Because there's such a thing as called a qualified longevity annuity contract that was put on the planet and developed by the IRS, our friends at the IRS, and the Department of the Treasury for use in IRA qualified type accounts for lifetime income, because Social Security was never put on the planet to be the sole annuity. And yes, it is the best inflation annuity on the planet, but the sole income source for people. They want people to use QLACs to enhance that income floor that they're building. So we have SPIAs, DIAs, and QLACs that are pretty much the same structure. No moving parts, no market attachments, no annual fees, nothing complex about that. If Warren Buffett bought annuities, these are the ones he'd buy, okay? Because they're simple. You can explain it to a 9-year-old, no offense to 9-year-olds. But with a lot of these companies, if you do it life only, meaning you're a misanthrope, you hate your beneficiaries, you don't have beneficiaries, you want the highest payment, a lot of these companies with the life only will not allow you to change the start date. But you can change the start date if it has a cash refund attached to it, or an installment refund attached to the life contingency, or period certain attached to it. They do allow that. So we're going to ask you the question. If you say, I want life only, I want the highest payment, I hate my family, I don't have any beneficiaries, listen to what I'm saying. We'll still say, but you do understand that you're going to defer it for 3 years or a year or 2 years, whatever you come up with the two questions. What do you want the money to contractually do? And when you want those contractual guarantees to start? We're going to make sure you understand that with the carrier that you chose, if it's life only, you're locked in. Okay. You say, well, I'm not sure I won't be locked in like that. I kind of want some flexibility. You know what I'm saying? I can't really reach over and touch my toes anymore, but I want flexibility with my income stream. You know what I'm saying? And we're going, okay, great. Then let's do life with installment refund, or life with cash refund, or life with a period certain. We can explain all those to you to make sure that you have the flexibility to change your mind. Because what's going to happen is when you buy a lifetime income stream that you're deferring, okay, we're going to be in touch with you about 90 days before that income stream starts. So give you an example. Let's just say you bought a deferred income annuity, life with cash refund, starting in 3 years. We're going to be in touch with you about 90 days before that start date to say, hey, Chester, you still want to turn on that income stream? You say, yep, lock and load. Then what we're going to do is verify the bank account that the money's going to hit, and it's going to be like turnkey. It's going to hit your bank account. But if you say, no, let's put that thing off for a while. I came into some money, I hit the lottery the other day, whatever, then we can push it out. And remember, the older you are, the higher the payment. The younger you are, the lower the payment. It's really that simple. But what I want you to take away from this phenomenally presented, shooting it straight with Stan, can we nod our head in unison? Is that you can change the start date of a lifetime income stream that you have planned to start in the future. You can change it if structured properly at the start, which is why you need us. Stan the Annuity Man, theannuityman.com, and my team understands how to do that so you can get to that fork in the road moment. It's an income fork in the road moment, and you pick up the income fork, and you have the ability to pivot. You can pivot to turn it on sooner. You can pivot to turn it on later, but you have the ability to pivot. How about that? Man, I'm rolling. I'm rolling. I'm like butter. I'm on a roll, as they say. So that's it. Annuity lifetime income. Remember, transfer of risk. Annuity solve for 4 things: principal protection, income for life, legacy, and long-term care. The acronym is PILL. We're talking about the I in PILL. Income for life. That income for life transfer risk strategy with annuities, typically 4 primary types: SPIAs, DIAs, QLACs, and income riders. We can structure it so that you have the ability to pivot and change that income start date. My name is Stan the Annuity Man. I am America's annuity agent, doggone it, and I am licensed in all 50 states and pay those fees every year. I'm a good citizen. And that's it. We'll see you next time.